When COVID happened, it was one day we were out and about, the next day Starbucks is closed down, you can't leave your home, you're confined, and oh, by the way, interest rates went up, utilities went up, taxes went up, and your tenants stopped paying rent, and now all of a sudden, all that income has dried up. And now real estate owners are A, trying to figure out how to handle that, and B, that was the source of income they were living off of, and so it's this two-part deal of how to handle that.
Hey everyone, welcome back to another episode of Commercial Connections, Investing with Confidence. I'm Rene, the producer, and today's episode tackles a topic that's suddenly hitting a lot of property owners fast: insurance cancellations and coverage challenges. Our host, Rene Nelson, CCIM, and I are here today with Gary Kelley. He is a partner at PCF Insurance, and he specializes in risk management consulting for the self-storage and real estate sector. In the last month, multiple apartment owners have received non-renewal notices or strict inspection demands from their insurers. And with aging roofs, old wiring, and outdated plumbing common in many buildings, it's critical that investors know what to expect. Gary brings clarity to what's triggering these cancellations, how to prepare for an inspection, and what your options are. Thanks for being on the show, Gary. We're excited to talk to you today.
Yeah, thanks for having me.
Gary, I'd love to jump in and talk to the listeners about commercial property insurance and why it's shifting so quickly. I've heard from several of my Oregon multifamily investors that have received notices from national insurance carriers that they are either going to be canceled or they have to do inspections and provide those inspections to the insurance companies. So can you walk us through what's happening in the insurance world and why are the underwriting dynamics changing?
That's a great question. And, it's funny, I was on a podcast yesterday for a different section of real estate or facet of real estate. And I kind of started with this. And so I'll do the same thing here because this is a perfect answer to that question. So last week, I received an article. The article says $1 billion disasters. It says, according to the U.S. 2024 $1 billion weather and climate disasters report, 27 disasters in 2024 caused an estimated $182.7 billion in losses. From 1980 to 2024, the number of events in a year was 9. The annual average in the last 5 years, 2020 to 2024, is 23 events. The high activity of extreme weather and climate events is becoming the new normal. That is a great way to kind of describe what is going on in insurance. And, from 1980 to 2020, the average catastrophic events was 9 a year. And now, in the past 4 years, we're averaging 23. And that's before you get to everyday claims. You hit a deer, a fender bender, house fire, tree falls on your home, the normal stuff, the claims that get reported on the daily all around the country that happen, slip and fall at your home type stuff. So the 182.7 billion is literally just 27 losses. That's wildfires, hurricane, tornadoes, floods, catastrophic type deals. So ultimately, the total amount of claims paid out is much higher than 180 some billion. It's billions more, but it just drives into the statistics of it, which is in the past, these 9 claims were called shock losses. You had a wildfire, 3 hurricanes happened. They were shock events. And the uncommon was uncommon. And in today's world, the uncommon is common. And everything that happens, this catastrophic flood in Texas that just occurred, it's never happened. The atmospheric rivers in California, the Palisades fire, the Maui fire, all these things that would just never happen are happening. And everything that happens is like, oh my gosh, this would never happen. And so the insurance industry is recognizing that the uncommon is now too expectedly common. We just don't know what it is and when it will be outside of the statistics of the numbers that are now consistently populating. So insurance companies are trying to figure out how to manage that and drive underwriting profitabilities and sustainability to ultimately stay solvent. And we're seeing certain states like Florida, Louisiana, California that are really struggling right now with carriers being solvent or having the ability to stay within that state due to extreme weather. And so multifamily has been really just tough. I think that it's claims driven in general. And part of that is because it's not somebody's home, it's a rental. And, people don't treat things that they don't own the same as when you rent it. And it's just part of the game, whether or not it's a rental home or an apartment. And then the other part of it is that a lot of apartments are older. And with any older property, you have circumstances, especially when you have people living in them. And so I think what we're experiencing right now is a high intake of claims on apartments on top of distressed properties. And again, with pre-COVID, the market was cash flush. Interest rates were low, cap rates were high, rental occupancies were all-time highs. And for real estate owners, they were able to do a lot with that excess income, right? Their net income was high. And they were living, that's what real estate owners live off of. They live off of that income. When COVID happened, interest rates at the same time, overnight, we'll say. In other words, it wasn't like over a year and a half, two, where real estate owners had time to adjust and make changes. It was one day we were out and about, the next day Starbucks is closed down, you can't leave your home, you're confined, and oh, by the way, interest rates went up and utilities went up and taxes went up and your tenants stopped paying rent. And now all of a sudden, all that income has dried up. And now real estate owners are A, trying to figure out how to handle that and what to do with it. And B, that was the source of income that they were living off of. And so it's this two-part deal of how to handle that. And so I think post that, with that post-COVID, COVID really marked the line in the sand of where that happened. In the market that we are today, is that now insurance companies, rates have gone up, the properties have had a lot of issues. And I always say that in the world of insurance, somebody's regulating something. It's either the insurance industry is regulating it or the state, municipality, government, a bank is regulating it. And most often one is driven by the other. Case in point, in 15 years ago, you might be surprised to know the state of Washington did not require tattoo parlors to carry insurance. Stunning. They must have had some issues because about 15 years ago, the state of Washington mandated tattoo parlors had to carry liability insurance, communicable disease insurance, professional liability insurance, in case you mess up or somebody gets poked by a dirty needle or something. And so the state required it. And then because they did that, they said, this is the requirements, and then turn around and the insurance industry is essentially regulating it because now that it's required, the insurance company has to supply it. And so all the state did was mandate it, but who's doing all the work? Insurance industry. And so it's a great example of a relationship of sometimes what's driving certain things. And with multifamily, I feel like right now the insurance industry is honestly regulating a lot of property-driven things that owners are experiencing through risk control inspections that are really afflicting. Case in point, electrical panels. If you have anything that's Challenger panels, stab block panels, Zinsco panels, aluminum wiring, you're getting required to replace it, get your aluminum wiring pigtailed. It is expensive. I firmly believe in the next 15 months to 3 years, there will not be any Zinsco panels anywhere. And it's not just apartments, it's office buildings, hotels, anything that has them, because every insurance company is requiring that they're getting removed as a result of the fire hazard and different risks associated with them. And so, that's a great example of insurance companies requiring that, owners are paying it, but it's really a product of just increased claims that we're seeing. And I don't really know the reason why these claims have ticked up so much. Again, I've been doing this 20 years, and I can just say from my own clientele, we've seen more claims. And part of the speculation is that with COVID, we were all home more. And by virtue of being home more, it created more opportunity for risk and exposure. Whereas before COVID, most people were out and about, right? You went to work, you went in, and you left your home. And so, now we're experiencing 7 days, 5 days a week, people being home 50 hours more than the past. Whether or not that's true or not, I don't know. But that has been the speculation within the insurance industry of what is driving all these excess claims. And really the only correlation is, again, that marker of, okay, you look at the chart of it's when it was like maybe like this, and it went like bell curve went way up, is really in COVID. I don't know if that answers your question or is a roundabout.
Let's also talk about the fact that you have been an underwriter, right? You were an underwriter for Travelers Insurance. So you have that experience and knowledge about what the insurance carrier is looking for. It's interesting. Now you're on the front end, though, as a producer, trying to help your clients and bridge the gap between you and the underwriter. So talk a little bit about that. Like, what experiences have you had in being able to advise your clients?
I think being an underwriter was extremely valuable. It has provided me an opportunity to know both sides. And it is a balancing act. Underwriters want the world. They're very in the box thinkers. Their job is to obviously mitigate risk for the carrier on behalf of the carrier, protect the investment, aka the premiums that they're collecting. While insurance is important and it serves a purpose, no insurance company wants to write a $10 million check. Not that they can't and they don't because they're obligated to per the policy, but nobody's like, I want to. And so, their job is to make sure that they find every way to not, make sure the wiring is good, the roofing is replaced, so that really, truly they're ensuring the catastrophic and minimizing the things. But it's a balancing act of how do you get underwriters to look at a property and say, okay, I'm comfortable with this, or I can make an exception on this, or I understand this and what's going on versus, drawing hard lines or staying in that box. Same thing with going to ownerships and helping them understand what's going on. And what I was explaining yesterday to this real estate group is that knowledge is power and options and empowering. And if I come to you and I say, this is what's up, most people can't hold that because they don't know the why, and your drives the why in life and whatever it is. It gives you purpose. And so it's right now, especially with apartments, everyone hates their premiums, everyone. And that's in one hand, and that can be very true, but owners understand that I've got claims or I was built in 1940 and and I'm non-sprinklered, and they can understand the reason why, which can also be true, then they can accept it. And both are true, but without both, there's no acceptance. Matter of fact, when you don't have the understanding, you just have the frustration, it becomes personal. And most owners are like, my insurance is inflicting me, my rates are going up. Insurance is now strictly a commodity because they haven't had a claim in 20 years. And it becomes a personal thing and a negative experience. And so the struggle really is just that, is obviously working to comply with the insurance companies who, at the end of the day, who have the gold make the rules, that's the insurance company. And so working within the confines of like, well, at the end of the day, they can or they can't, or they make the rules. And how do we operate within those or work to bend them in a degree that we can get what we want, as well as help a client understand what's going on and what we can do to, the same thing, work in a way, because sometimes there are options to meet what underwriters need without going through the litany of the rigmarole. And so that is the balancing. And I think ultimately being an underwriter helps both, because I've been on both sides, and you help it. Underwriters appreciate somebody who understands them, and most producers don't. Insurance is price driven. If I can get a better price, I can sell it. If it's lower, I win. If it's lower, the client's happy. And the reality is we're in the hardest insurance market in 50 years the industry has ever seen. And so lower prices isn't always attainable right now. And so again, it's not means that it's not possible, but it is more important to be able to explain what is going on, explain what is happening, help a client understand the net rates and what they can do to directly impact their property and give them options so that they feel empowered to be like, okay, again, it goes back to that. It's one of my 5 in risk management, rather than I just pay all this premium and I don't really see any purpose because I don't have an issue type.
What are some of the most common deficiencies that lead to non-renewals? You touched briefly on electrical. I know roofing is one, as well as plumbing. I'm curious too, did the insurance companies just look at the age of the building and that's kind of where it's maybe a red flag for them and it comes up on their radar of hey, this property may have some issues?
Yeah, that's a really good question. So again, what we're dealing with in the market right now is a mass influx of inflation. And so 15 years ago, 10 years ago, we were insuring apartments for $99 a square foot. Today, we're quoting them at 100. I mean, I just quoted one brand new built in Wenatchee, $85, $285 a square foot. That 10, 15 years ago would have been $99, $105 a square foot. And so what we're dealing with is we're dealing with inflation, increased costs of materials, labor shortages still, COVID, but which consequently is making labor more expensive, driving a lot of properties to delay certain things. And whether or not properties are super maintained or not, insurance companies, as a result of the marketplace right now and knowing that everything is changing from a replacement cost standpoint, are very conscious as to, okay, it's not necessarily property specific, but more so age specific. We know that the average lifespan of an average roof, maybe you have a different roof, and that's, would be circumstantial, specific to the property. But on average, general roofs have a lifespan of 30 years. On average, wiring before a certain year tends to be aluminum. On average, plumbing before a certain year tends to be galvanized. And then when you have those type of things, the statistics show there tend to be these issues. Same thing with electrical panels. So a lot of times underwriters right now, I mean, really simply put, are like, oh, I got an apartment built in 1972 and I see that it's frame and non-sprinkler. Okay, we want to know if there are ever any updates. And really they're asking for the big four. They're asking, is the roofing been updated, the heating been updated, the wiring been updated, and the electrical been updated? And not all necessarily have to be, but oftentimes in the wiring and the plumbing, they're looking to know, is it copper? Is the wiring and the plumbing copper? So a lot of times people will know there's no updates because people want to do as little as possible when they're answering insurance stuff rather than trying to see the purpose of the question, which is, what are we really getting at? What we're really getting is, I haven't replaced my wiring because it's not necessarily feasible to rewire my building. And I don't know why I would when it's copper. Nobody is. And then, if your roofs are older than 35, 40 years, anyone is going to require it to be replaced. And so ultimately, those are the big four that they're getting at. And then, if you haven't, what they want to know is, what are you going to do about it? Okay, well, my roof is 35 years old. It's not replaced, but I have it in my capital improvement plan to replace it this fall. So an insurance company knows, oh, okay, this is what I'm doing. The rest of the stuff is cosmetic. It's not necessarily insurance. They like to hear it, but it's really best practices, right? Oh, I repaint it. Great. You should do that anyhow because nobody wants to live in an apartment complex with peeling paint. I keep it tidy. I don't have trash pallets. Like, that's good. That's a best practice. And so a lot of times owners will come back with that stuff, the stuff that's, I don't want to dismiss as not saying important, but it's ancillary. Insurance companies, they're really not fazed by it. And if anything, that stuff, like if they go online and they Google your property, which they're all doing, they see nice pictures, they factor that into their pricing, right? Because an insurance company has a state allocated, a filed rate that they can provide. And then with commercial insurance, they we'll say X amount of percentage where they can give none or they can give all and for additional credits on pricing. And so all that kind of goes into an underwriter's review when they're saying, okay, you have to think about it as like, we have the property and then you have the insurance company and then we have a funnel. And it's like, think of a gumball going down the machine. And it's like, you first started in, the gumball's down. And it's like, okay, can the insurance company do it? Does it meet their appetite? Yes. Okay. Does it? Then it gets a little farther in the review process. Okay. Yes. Okay. Then is the pricing appropriate? Then can I apply credit all the way down? And then when it pops out the chute, there's your quote. And so really the idea is the beginning is, again, not every insurance company can do an 8-story apartment complex. So if you've got a high rise right there, some insurance companies are going to say, can't do it, it's out. Well, then if it does meet their appetites, you come down and it's making it look better and better. And all those ancillary things help the pricing to get better. Whereas, one insurance company might quote it, aggressively and one doesn't. And so I think that's really, really important in terms of, again, focusing on and knowing as an ownership what an insurance company is really looking for. And it's really those top four.
Let's say the property owner and I own that 1974 apartment and I want to be proactive. And let's say it's the electrical. What would I do? Would I call an electrical company and say, hey, could you come do an electrical inspection unit by unit? I just want to make sure everything is current and in case my insurance company asks for an inspection report. How do you do that?
Yeah, a lot of insurance companies are wanting, I'm not saying it's realistic, but are wanting annual, as part of your best practices, like annual inspections. That sounds overwhelming, but really it's like anything else. You go to the dentist twice a year. I mean, I work at home. I have once a year, I have a contract, or a membership. Everything's a membership. I have a membership with a plumbing company and an electrical company. And I pay the $50 a year to be a member and be a preferred member. But every year they come out as a part of that and they do an inspection. And funny enough is every time they've come out, they found an issue, like a legitimate issue, not like a little ticky tack. It's the same thing of like what insurance companies are really wanting to hear, especially in the market, the state of the union of the market, is properties that say, yeah, every year I just have my roofer come out, and they do a walkthrough and they inspect the roofs. We have storms, we have adverse weather, we have this, we have that. It's worth $1,500, $500 to have a professional get on the roof and make sure we don't have issues. Same thing with an electrician or a plumber. And they're already doing some of this. Properties that are sprinkler, they already have to do annual sprinkler reports and have somebody do that. The fire department already comes out, has inspections. So it's just different layers. And some management companies already do that, depending on the management company, where they'll have, capital improvement plans in place. And when you hire the management company, by virtue of hiring them, they're doing this anyhow. So I think that's in one aspect or another, one way to do it.
Okay, cool. And if someone gets a cancellation letter, what do they do other than take a deep breath? What's their next step?
I think the next step is to really try to understand why. And I'd like to reinforce, read the letter. A lot of letters are not cancellation notice. If it says conditional renewal notice, I will admit all day long they are the most poorly worded letters. But oftentimes in the second or third sentence, it literally says, we have a desire to renew, but we need to re-review the entire submission, meaning it's not an automatic renewal. And in most states, if it's not an automatic renewal, the insurance company has to essentially provide, to meet state compliance, notice of non-renewal or a conditional non-renewal letter because it's not renewing, which is what happens every year. So first thing is just read the letter, because you might find that it's actually not as scary as you think. Second thing is, when in doubt, send it to your agent and have them just affirm. And then third of all is, if you do have a cancellation letter, really try to figure out why without the panic. Well, what's going on? What is it? Because some of it might be silly. Like, for instance, a lot of owners, they don't think doing the inspections are serious. And so a lot of them will ignore it. And then come the renewal, the insurance company's like, well, you didn't do it. And since you're not complying with the inspection, we're not renewing. And then all of a sudden they're like, oh, I'll do it. It's like, great. And sometimes it's things of, okay, can we do something? Or what are the items that we need to do, which would be the agent going back to the underwriter to say, okay, what's driving the non-renewal? And is there anything we can do to revoke the non-renewal? And sometimes the underwriter might come back and say, these 5 items need to be taken care of. And if so, and we can get confirmation, we'll rescind the renewal. And sometimes they'll come back and say, no, we've changed our appetite and we just can't do it. In which case, then, your agent's going back out to market and reshopping it. And I'm sure a lot of owners right now are experiencing that, especially if you've got older properties. And so then it's just, the question is, who's your broker? How many options do they have in terms of markets that they're going out to, and the accessibility and availability, and, how much of whatever real estate they have. In this case, we're talking multifamily, but whether or not it's shopping centers or office buildings, or, what's their experience in that arena? Because in this tough market, what we're finding is not that, insurance agents up the yin yang, anybody can write an apartment complex. It's if you do a lot of something and you have a lot of business and you work with that underwriter a lot, you garner a lot of leverage. because underwriters are doing a lot with you and they want to maintain that. They are, in a relationship standpoint, they're kind of locking in the craziness.
I heard that recently from an insurance agent who was representing a buyer on a transaction that I was doing, but I wasn't sure if that was true or if maybe he was just trying to brag or puff a little bit. But it sounds like it really is true. If you have a relationship with an underwriter that does a lot of business with you, then you do have a little more clout, so to speak, or they try to work with you a little more.
I would say yes, that's true to a certain degree. I don't think on the whole underwriters will price anything better because you're you and I'm me. From an underwriting side and being on that, a carrier would say that's inappropriate or unethical. So I would say most underwriters aren't necessarily doing that because they still have their underwriting criteria, right? They're supposed to say, okay, well, I price discounts for this and this is my appetite to here. And so there's a systematic for pricing. But I recently talked to an underwriter and he was saying, I mean, right now, everything is getting shopped, especially in real estate. Rates are going up. Again, values are going up, even if your rates aren't going up. But again, as I said, if 5 years ago you were at $150 a square foot, today you're at $250 a square foot. And let's just say there's no inflation and your rate's exactly the same, your value still increased to $100 a square foot. So your rate's still going up significantly just by value, right? And so everything is being marketed from the real estate industry and on an insurance perspective. And so underwriters are honestly, this one underwriter is like, we literally, each underwriter on my team, he goes, we're getting 400 or 500 submissions a week. And these are one people, right? And insurance companies and all these people. And it's not necessarily true in the sense that an underwriter has a territory and you might have an underwriter, like for instance, when I was at Travelers, I had like 15, 20 different insurance agencies that I worked with. If every agent producer is sending me 5 submissions a week, and we'll just say, I'm making this up, there are 10 agents at every agency, I do the math, you go 5 submissions times 10 agents times 7 days a week times, we'll go 20 agencies, that's 1,100 submissions a week as one person. This is where the relationship comes in because an underwriter in today's market, 20 years ago when I started, insurance was 10 cents on the dollar. I remember starting and people 30 years experience would be like, oh, you have no idea. And I'd be like, I didn't have an idea. First out of college, I got out of Gonzaga and I was like, oh, I don't know. And then this account would be $100,000. And today we're doing it for $15,000. Insurance companies this is right after the subprimes. Insurance companies were writing as much business as they could to make up for the premium that they weren't getting. They're just writing it. Today, all these submissions are coming in. Carriers are going, too difficult, don't want to do it. Agent doesn't get me what we need. They didn't provide a full submission. I'm not comfortable. And so what they're going through and they're like, I really like that one. I'm comfortable. I trust him. I trust her. I've got a full submission. And, when our time is limited, if they like who they're working with, they trust who they're working with, they know what they're getting, they know it's good business, they know they can write it, right? I'm not just throwing you submissions and my quote to buying ratio is low, which could be the case for a lot of underwriters. They don't want to waste their time. And so to really validate that, Rene, I think that's really the crux of it, is to say, yeah, underwriters look at it and they go, who can I write business with? Who do I like? Who do I trust? And where can I get wins and maximize my time? And then they're still going through their process. But yeah, it's very much right now. More than ever, personal relationship is paying off. And you feel it when you don't, because we all have underwriters and carriers that we don't have good relationships, every broker. And when you don't, you just feel it. They don't return calls. You don't get great pricing. You will see a quote from this other one come in from some other broker and you see it on the table and you're like, well, how come they quote that? Well, they like them. You know what I mean? So it's just a game. And it's also a reminder to us in the profession it's why you work to build relationships. And just as much as us to our clients, it shouldn't be transactional. From a broker to an underwriter relationship, it should not be transactional. It should be very relational. So.
On those 1,100 applications that underwriter is reviewing, are they physically reviewing that, or does it go into like a software system that kind of checks some of the boxes for them and then they review the underwriting findings, so to speak?
Most of them are physical. Every insurance company has small business platforms. This is like your small stuff. This is like your coffee stands, your little restaurant, your Mexican restaurant, your Thai food, your burger joint, your 5,000 square foot office building type stuff, small apartments type stuff. You go online, you quote it up with Travelers or Liberty, whatever. It flows through the system. You refer to an underwriter and, they promise a 24-hour turnaround because it's, an underwriter's getting it. It's in their queue. They're really looking at it and it either qualifies or it doesn't. The pricing is what it is. And it's like decline or approve, decline or approve. And so that's really systematic. Everything else, contractors, manufacturers, larger properties, larger values, internally insurance companies have towers of where it like falls if it's above or below. It's what separates it. And so most of this is physical submissions. You're sending in applications, you're sending in loss runs, you're sending in supplemental applications, answering questions. It's getting to an underwriter's desk, and then you're corresponding with the underwriter. They may have questions, they may don't. Most do. And so it's time consuming. And so, yeah, I can just tell you right now, I just made those numbers up. But again, most underwriters have a number of agencies. And it's a number of agents. And again, if you're just getting 2 submissions a week and it's half that, it's still 700. They're not getting all of them. You're a fraction of them. My perspective from an insurance agent, it's more important to get good information and the right information to underwrite. And we're hearing this from clients. Again, 5 years ago, nobody asked anything. You could send something in. I remember 8 years ago before COVID, we were writing, I won't name the carrier, but we were writing 1920s, 30s, 40s apartments. Ask no questions. I was like, it's a good play. It looks fantastic. Boom, had a quote, $8,000, no big deal, And today it's like a cavity search. It's like, well, what's this and what's this and what's that? And I want this. In 20 years, I've never had insurance companies require I provide certificates of occupancy after they do an expansion or build a property. Why are they doing that? Because rates are so high and the market is so tough that they're finding their builders' risk is coming up and they're close, but they're not there yet and they don't want to pay the expensive premium over here. So they just do it over here. And then insurance companies are having claims and they're realizing, well, wait a sec, you're still under construction.
Oh, wow.
And so insurance companies are starting to ask just these questions that I know owners, it makes them want to pull their hair out and they're just like this. We are too, because I'm like, in 20 years, it's a litany of things. And I'm like, nobody's ever asked me that before. Huh?
Mm-hmm.
What? Do I really have to get this? Yep. And it's like, go to the same thing. Because underwriters, when you go back to these things, the number of submissions, that's how they weed you out, right? It's like, well, I don't have to necessarily provide them that information, but if they're like, give me this, and you don't do it, now you don't get a quote.
Okay, I have 2 questions. One, does credit score, your personal credit score, does that play in for your insurance premiums?
Generally speaking, no. Commercial insurance is not so much. Some insurance companies take some aspect of financial score or financial standings into account, and it's really through like Dun & Bradstreet type stuff. Mm-hmm. I can tell you that Dun & Bradstreet, as a former underwriter, I don't feel is always accurate. In other words, as an underwriter, I've seen companies have a lower score, A, B, C, D, F on Dun & Bradstreet, but it might be because they're undergoing significant growth, right? So you might have an investor that's got multiple apartments that keeps refinancing and has an influx of capital and is buying. And on paper, the Dun & Bradstreet is low. This doesn't exactly mean that their financial credibility is poor. It might just generate more questions. Very rarely do I find a declination for an insurance company because of that. And when it does come up, knowing the client, I'm like I recently had one and we had a really hard time quoting it. But he was also going through bankruptcy. Mm-hmm. And I'm not disclosing that. I don't think that's necessarily an insurance. It doesn't necessarily, insurance company doesn't need to know that, but they don't like it. And if they ask the question and we're honest about it, but again, this bankruptcy was reflecting on somehow, however it works, on Dun and Bradstreet, and it generated a lot of questions. And it's like it can all depend. So to answer your question, no, it's not like personal insurance. Yes, credit based. Home and auto, yeah.
Okay, great. And then you've talked a lot about relationships. I'm really curious. I've had a 35-year relationship with my State Farm agent. My best friend shops insurance almost every year and changes carriers. How much does that play in? I own commercial real estate myself. That's one reason that I stick with the same insurance company and the same agent. I hadn't had a claim for years. And last year we had a really bad freeze. I had a pipe break, and I'm glad that I had that relationship with my agent because she really fought to keep my premiums low and not have my insurance canceled. How much does that play in a relationship where you continually use the same agent versus shopping?
Yeah, that's a good question. I think it's important. I'll say that loosely in the sense that obviously as a broker, I want total loyalty, right? I do understand when insurance clients shop, as a business owner, I'm like, get it, to a certain degree. I also believe that there's a difference between shopping your insurance and what you're doing, again, why you're doing it and what you're doing. And so most people, I think, need to recognize what they have and what they're doing. So like, for instance, your State Farm agent, your State Farms, Farmers, American Families, Geico's, those guys are all what we call direct writers or captives, meaning that State Farm represents State Farm, Farmers represents Farmers, and that's what they're doing. And so I think shopping that is a little bit different than a broker like me in shopping because we have a plethora of markets. So I think if you're with a direct writer, you're shopping because you want to make sure that Farmers doesn't have Travelers, Liberty, Hartford, CNA, Pemco, Mutual, Venum Claw, et cetera, Oregon Mutual, et cetera, et cetera, et cetera, right? So if you're with a direct writer, you might want to go out and see and the open market compete with my direct writer. That's one. Number two is understanding who your agent is and what their capacity is. If you have an agent with limited markets, you might go to another broker agent because you feel like you want to make sure that you are accessing the market, a larger share of the market, because I have a smaller hometown agent and they might not have a ton of options type thing. Versus most people, if they start shopping their broker, you ask the question, well, you have a problem? Are you frustrated? Or are you looking to fire them, right? Because if one of those are the issue, well, then it makes sense, right? You're trying to find a different avenue versus, again, utilizing your trusted partner to go out to market and shop for you on behalf of you to do exactly what you want, which is to shop the insurance. I think there's a difference of that versus, in finding a different solution than going to multiple agents because what people think is, well, it's a game and it's insurance and insurance is a scam and they're in sales. And so I'm going to go every which way to try to find a way to find the kink in the system, which honestly only ends up hurting the client because what we'll call those people, they're serial quoters. And that does impact the things because regardless of us, is an insurance company, everything's so systematic, right? Once you send a submission in, that data is in their system. You could send in an account, let's say a Red Robin. You could send in a Red Robin, and 10 years ago, if they looked at it, it'd be in Liberty's system, and they would know it. And if they used to write it, they would have all the information. If they risk controlled it, did a survey, they would have that from 10 years ago. They know. And so what owners aren't thinking is you wear the market out. Think of that 1,100 submissions. You wear the market out when you submit it every single year. And we have these conversations where they're like shop. And they're like, hey, you're burning the market out because depending on your size, and really it's the larger you get, they seem to be more cost conscious, right? On a $200,000 premium, 10% is over 20 grand, right? And that's a lot of money when your premium goes up 20, 30, 40 grand. And you just can't shop the insurance because every year, because an 8% renewal, whether it's $500 or it's $500,000, is still a good percentage if that's the average in the market. And so Insurance companies look at that and they say, well, I've seen this account the last 5 years in a row. It's not viable. I'm not going to get it. It's not worth my time. They've had claims. I'm throwing right in Underwriters. This is what we hear.
Yeah.
Therefore, they instantly decline it, and this owner has lost the opportunity for the underwriter to legitimately review it because it's been overshopped and it's on their desk number of times, rather than depending on the property. And the aim is to trust the broker to advise you correctly on this, to say, hey, you know what? We should take a break on this. We should have an every other year marketing plan, or every third year, unless there's an adverse circumstance. Your premium goes up 15, 20%. You get a notice of non-renewal and we have to do it. But we can't, just because your insurance premium goes up 7% and you don't like it, just reshop it on an annual basis. So that's what I'd say to that.
Oh, that's so interesting. Well, thanks for that insight. That's super helpful, because I think a lot of people think, oh, my premium's too high, I'm just going to go shop it, but they're actually damaging their opportunity, it sounds like. So that's great advice.
Yeah, again, I don't want to dismiss anybody wanting to shop their insurance. I think there's validation for that. I think it's fair in a capitalistic society to say, hey, can we find another premium? I did this to an underwriter. I literally got a renewal and I went back to her and I said, that ain't going to work. 19% this year. It was 24% last year. It was 17% the year before. Fix it, or we're finding another solution, right? And that's me advocating for my client, and we are reshopping it. Mm-hmm. So I think there's definitely there's value in shopping your insurance, but I think it really comes back to why. Do you not like your broker or agent? Do you feel like that you don't trust them and there's some issue that you're searching to fix by virtue of and consequently trying to find another outfit? Or have you taken significant rate increases? But what we find more often than not in the commoditization of it is that people are like, well, my insurance premiums are up and I don't like it. And again, I would turn around and say, I don't think that's inappropriate, again, for an owner to say, I don't like my premiums. It's now their agent's responsibility to explain them why, which may justify reshopping and it may not. Like, case in point, I had a client in another state, very large client. They're paying like $500,000 premium, real estate driven account. They had 14 claims in 9 months last year.
Wow.
Before I even gave them the renewal, they said, we're expecting a premium reduction. Before I even give them a renewal, I literally said, I'm coming out to visit you. I booked a flight and flew out the next week. And I told my wife, I said, this is not a price conversation. This is an education conversation. And when I sat down to them, they were like this in their chair when their premium went up $400,000. Well, the insurance premiums paid out several $100,000. You had frequency. Insurance, there's a proverb that says frequency breeds severity. Maybe true, maybe not, but the insurance companies are pretty dialed in on their statistics, meaning that if you have 8 claims, it's just a matter of time before that 9th, 10th, or 11th is a massive pop, right? Mm-hmm. And so, again, that's the broker's responsibility of really trying to help. In this case, we had shopped the insurance because they were getting non-renewed, and so we had to find another solution for them. But the point of it is that sometimes, again, helping them understand of like, here's your marketing, here's what we did, here's what we shopped it, here's the why behind the what, to where when they did, they say, you know what, okay, well, now we're definitely going to change what we do internally and how we handle certain claims that came in. I was like, fantastic. And I'll help you any way I want. And every claim they had, I would give them my input, and every claim they had, they're like, report it. I'm like, okay, we support whatever you want to do. Mm-hmm. In this case, it caught up to them. And so it's stuff like that.
How do you weigh and measure whether you should report a claim or whether you should maybe just pay for that out of pocket yourself?
So I really gauge it on 3 things. Number 1 is anything that's like what I would call maintenance oriented. Insurance companies are not maintenance policies. A lot of owners treat it as such. They're like, oh, I got a $1,500 claim, report the insurance. That's maintenance, even if it's reportable. And so I would say 1, is it maintenance oriented? Or is it, why you buy insurance for the catastrophic? Number 2, I always tell people, never report a claim if it's less than double the deductible. It's just not worth it. If you have a $5,000 deductible, you shouldn't report a claim at $7,500. You just shouldn't do it. You're going to get $2,500 back. It's not worth it. And to be honest with you, 19 out of 20, 45 out of 50 real estate owners can afford to pay it. They don't want to, but they can't. But I would tell you the same thing for your personal home and auto. If you have a $1,000 auto deductible, you get an offender bender, and it's $2,000 to fix the damage, don't report the claim. Nobody wants to pay the damage, but it's not worth it from the impact that it's going to have on your insurance. So there's a variable to that. If you have a $50,000 deductible, I wouldn't tell you wait until it's 100, right? $50,000 is a lot of money back. So the higher your deductible, the more variable that gets. But under $25,000 deductibles, you shouldn't be reporting deductibles if it's you're less than double your deductible. The second part is your broker giving you risk management advice and turning around and saying, hey, you know what? You've had 3 claims in the past 2 years. 3 are water claims. One is the weather claim. Okay, whatever. I can fight against that because you can't control the weather and God. And, another one is whatever, some rando. In providing you feedback of saying, again, I always preface to my clients, hey, I will support whatever you want to do. But bing, 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 boom, boom, boom. Had this happen at a hotel yesterday. Ask me about a claim. They have a claim. And I respond. They said, "Will it affect my premium?" I said, "Yes, probably, because the nature of the claim and the lawsuit that came in is not becoming. It's an allegation. So, you got to iron that out between said attorney and your attorney and or insurance company." So, but you've also had 2 of these other claims in the past 3 years in these clusters of properties. But you also got a formal demand letter from an attorney. And I would recommend, because it's a formal demand letter from an attorney and it's a liability claim, that you should report a claim so that you don't compromise coverage, because this circumstance was a big deal. Mm-hmm. Versus it being like, this is my 3rd claim for a property leak, and these leaks are $10,000 a piece. And it's like, this is your 3rd one. Do you really want a 4th? And again, every property is different. Sometimes the financials are like, unfortunately, we have to. Okay. But really what you're trying to drive down is, again, the need versus the want and the balance between that.
Oh, that's interesting. Do water claims carry a more significant weight for an underwriter when they're looking at past claims?
Yes, no. I mean, a claim's a claim. Again, 10 years ago, this, Rene. 10 years ago, in anything, insurance. It used to be this in your personal car. Somebody hit me and they didn't have insurance, and your premium wouldn't change. Mm-hmm. Insurance company would be like, yeah, it's not your fault. Oh, sweet. Even if they paid out an uninsured motorist, they'd be like, I'm not holding Rene responsible. You didn't do it. It's not your fault. Today, a dollar paid is a dollar paid. So yes and no, in that a claim's a claim, and a dollar of premium collected versus a dollar of premium paid creates a loss percentage. And, obviously if it's over a dollar, then they're losing money. If it's under a dollar, 1.0, then they're making money. But water claims are unique, because if there's multiple claims, it starts to highlight, like, it's like health, right? I keep having these health issues, and you're like, what's going on in the body, right? And you start digging, and it's the same thing with water claims. It's like, well, okay, we had 1, and what was that 1? Okay, we have 1. It was a freak. But then you have 2, and then you have 3, and you're just like, okay, well, are all the water heaters bad since this is the 3rd or 4th one? Is the plumbing? Like, I just had a condo that has had multiple water claims, and they have another claim, and they're like, they called and they said, we really don't want to report the claim, but here's the circumstance. And apparently a unit owner was doing work on a toilet or something behind the toilet, and it caused a water loss. And they're like, oh, it's not our fault because the plumbing's brittle. The plumbing was brittle. And I go, okay. Problem number 1, the plumbing's brittle. Problem number 2 is that wear, tear, deterioration is not covered. But that's not the cause of the loss. It's the unit owner working on the pipe that caused it. I said, but we've had multiple water losses, and you're calling me telling me the plumbing's brittle. So now if the plumbing's brittle, it's not just this one unit, it's the building. And so, yes, Rene, I think water losses And this is kind of, it goes back to, for multifamily, the problem the industry is seeing with these older buildings. They're compounding problems that are starting to arise that offer a lot more risk to insurance companies. Again, I don't like it either, but ultimately that's the root cause of it. Is insurance companies are indicating they don't feel comfortable with certain types of properties because of said characteristics for that very reason.
A question before we wrap up. In the credit industry, there's subprime interest rates. If you've got low credit scores, if someone receives a cancellation letter, is there such a thing as subprime insurance where, maybe you're going to pay 50% higher in a premium, but you can still get coverage?
That's a great question. I'm looking kind of here at some of your outline questions or topics. And I think you mentioned like the Oregon Fair Plan. That might be kind of what you're driving at. I'm going to answer that question with a no. Typically in insurance, somebody will write something. Like case in point, Progressive will write anything. You've got 8 tickets, they'll write you. Your auto insurance premium might be $10,000, but they'll write you. And maybe Travelers, Liberty, Hartford, CNA, Philadelphia, might not be able to write you. Lloyd's of London probably will. Markel probably will. Scottsdale, a substandard, non-admitted insurance company. So there generally is a market. I can tell you in 20 years, I've never had to go to the Washington State Fair Plan or the Oregon State Fair Plan. Now, California, I do a lot of real estate all around the country. California, I go to the California State Fair Plan all the time. And today's market, the California Fair Plan is the number one insurer in the state of California, really driven by these wildfires.
Wow.
Never experienced it. I never thought I would see a day California would be tougher than Texas. And Texas is hard because of the weather and the storms. But California is tougher than Texas because carriers are pulling out and literally you'll get to a point where 100% of the market will be like, I will not do it because the wildfire score is a 95 out of 100. Where do you go? California Fair Plan. So yes, in Washington, Oregon, there is the Fair Plan, the Oregon State Fair Plan, Washington State Fair Plan, that if you cannot get insurance, truly cannot get insurance, you would go to the Fair Plan. And I'm not saying there aren't circumstances that wouldn't merit that. Again, in almost 20 years of being a broker, I have not had one property ever had to go to either. But what you're looking at is typically pretty old, distressed properties or properties that are so far out in the middle of nowhere in such high risk areas that an insurance company wouldn't want to do it.
Yeah, that makes sense. Wow. You have been an amazing plethora of information, Gary. We're so grateful for your information. If there's one thing that you wanted the listeners to know about insurance, what recommendation would you give them?
Oh, that's a good question. I've been waiting for this one. I'd say hold on to your shorts. Just hang in there. Insurance is a pendulum. It truly is. And if you've been in the real estate industry for a long time, you know that it swings. I don't quote me on this, but I will say my opinion of this has been that the insurance market is prime for a shift. And we're starting to see it. I just had a very large building in Seattle that was paying close to $500,000 in insurance go down $186,000 in the renewals tomorrow. We are starting to see pockets of the market shift and change on the real estate. And I say that because economically, the economy and insurance is bound together. When the economy shifts, insurance shifts, and they mirror each other. And if you look at the statistics in the history in the past 45 years, it's tied to the presidency. And we've had 8-year terms since Bush Sr., Biden, and Trump. Trump 1.0. Trump 1.0 and Biden together marked not only 4 years of volatility for each, but they also marked a combination of 8 years. And when you look at the statistics, the pendulum of the economy has been on this 8-year swing that's tied with the presidency. So I don't think it's a political thing. I don't think it would have been a Trump, a Biden, a Kamala, a Republican, a Democrat thing. I think that we were at the 8-year mark. And if the statistics retain to be true and consistent with the historical data, the economy is primed for the shift which again, if that occurs, the insurance market runs parallel to that and congruent to that. And with any presidency, it takes 15 months for any administration's two plans to start to unfold. So we're starting to see that and hear murmurs. I'm optimistic about it. Either somebody's going to come back to me, I swear, in next year and be like, "You're full of it," or they're going to be like, "Whoa," and I'm going to be like, "No, it's just data. It's just data. No politics, just data." But my encouragement to property owners is just hang in there. Insurance is worth it. Trust me, it's valuable. We see it at its worst, and we see it often, and it will change. And just to find a broker that you trust and that you rely on, and really, if you view them as a part of your trusted five, then I think you'll find the experience is different. If you're not, then it is time to, it's no different than your CPA and your attorney. If you don't have a good CPA, find a good CPA. If you don't have a good attorney, find a good attorney, one that you trust, one that you like, and one that you enjoy doing business with. And when you have those three, it's smooth. And so I think that's my encouragement, is just to hang in there and to make sure you know what you have. And if you don't, seek somebody who does. And yeah.
I think that's so crazy that there's this, I never really thought about it before, but that push and pull between the insurance and the company owners. And I hope one day we can live in a utopia where we kind of work together. What would be your utopia universe for where there's just trust and less friction in the market?
I don't know if there is a utopia to it, because even when insurance premiums are low, everyone always wants better, right? I validate owners right now. Honestly, it is frustrating. It is really tough to go to a business owner and say, "Hey, I'm really sorry your premium went from 40,000 to 90." It's really tough to deliver those messages. They're angry. They're upset. Yeah. It's inflicting. Even if they understand it, it's tough. And so I think the biggest part is just, again, I think it's our job to be able to hold that, right? And you think about it just like, your significant other and being heard and being seen. And it's the same thing with your clients, in allowing them to be heard and be seen and validated and understand that, yeah, when your premiums are inflicting, that makes sense. But at the same time, I think we have a responsibility. I have a responsibility to do the best we can, be honest, advocate for our clients, and be able to communicate and explain it. And I think that's the key, because I'm confident in saying that I don't think a lot of agents, brokers do a great job of communicating it. And I think that if you were to poll property owners, I think they would validate that. They would say, "I don't really know why, and I don't really understand." And again, when you don't have the knowledge, you aren't empowered. Knowledge is power and options are empowering. And if you don't have those things, just in general, it can be frustrating. So I think my utopia is just that people find the right places to have that knowledge and be empowered in the options. And I think that's the beauty of insurance, is that it's a free market and you get to have options and find the right thing and know that you have a good thing.
Yeah, I think that's really good advice on both sides. And I think you did such a good job on speaking to people in your industry and then the people using the services, and how we can just best work together. Yeah, because it's so shifting right now. But it's good to hear your predictions, to see what's coming, and fingers crossed and backed by the data. So I think that makes a lot of sense. And thank you so much for laying out what's happening in the insurance world and what steps you can take to protect your coverage and what you can do if your insurer starts to walk away. Be sure to check out the show notes for contact info. We can put in your business LinkedIn. Is LinkedIn the best way to get a hold of you?
Yeah, you can do that. Honestly, my cell phone's great. Yeah, that's probably the best. But yeah, any information, whether or not it's LinkedIn, email, cell phone number.
Thanks, Gary.
Yeah, I really appreciate you guys having me.